Jamie Dimon just gave one of the loudest warnings in modern finance. And this time, he was not talking about a normal recession. He was talking about a bond crisis, a debt system stretched too far, a government borrowing too much, a private credit market growing too fast, and a financial machine where the hidden risk is no longer hidden. A few hours ago, Minority Mindset broke down Jamie Dimon's warning about America's debt problem and the growing stress inside private credit. Jasprit focused on the investor side, how to think about treasury bills, gold, energy, defense, and how to protect yourself when the system starts to shake. That analysis matters. But this episode is about the part most investing videos do not show. What happens when the debt crisis leaves Wall Street and enters ordinary life? What happens when private credit stress moves from fund documents into layoffs, tighter lending, frozen withdrawals, higher rates, and weaker savings? Welcome back to Broken Economy. Today, we are looking at Jamie Dimon's warning through the lens of the real economy. Because from Wall Street, this looks like a credit cycle. From the banking system, it looks like risk management. From the private credit industry, it looks like markdowns, redemptions, and restructuring. But from the street, it looks like fewer jobs, higher debt costs, small businesses closing, and families using credit cards just to survive. The first thing to understand is this: America is no longer just running a debt problem. America is running a debt machine. The federal government borrows, consumers borrow, businesses borrow, private equity borrows, real estate borrows, corporations refinance, households roll balances, and the entire system depends on one assumption: there will always be someone willing to lend more money at a price the system can survive. That assumption is now being tested. Jamie Dimon's warning matters because he is not some random doomsday voice on the internet. He runs the largest bank in America. He sees credit conditions. He sees corporate stress. He sees consumer behavior. He sees treasury markets. He sees how money moves when confidence starts to weaken. So when someone like Jamie Dimon warns about a bond crisis, the question is not whether the exact date is tomorrow. The question is why the warning is getting louder now. The answer is simple. Debt has become too large to ignore. The United States is approaching a debt level near $40 trillion. The government spends far more than it collects. Interest costs are rising. And every year, more money has to be borrowed just to keep the system running. This creates a dangerous loop. The government borrows more. Bond supply increases. Investors demand higher yields. Higher yields make interest payments more expensive. Higher interest payments increase the deficit. The deficit requires more borrowing, and the cycle repeats. That is the bond market trap. And once a government enters that trap, the problem is not just political. It becomes mathematical. You cannot talk your way out of compounding interest. You cannot campaign your way out of rising debt service. You cannot print confidence forever. At some point, the market starts asking a very simple question: who is going to buy all this debt? That is where the second layer begins. For decades, the United States benefited from massive demand for Treasury bonds. Foreign governments bought them. Pension funds bought them. Insurance companies bought them. Banks bought them. Retirement accounts bought them. The Federal Reserve bought them. Treasuries were treated as the safest asset in the world. But when debt grows faster than trust, even safe assets start to look different. If investors demand higher yields to hold US debt, borrowing costs rise. If borrowing costs rise, the government's financial position gets worse. If the government's financial position gets worse, investors demand even more yield. That is how a bond crisis can begin. Not with one dramatic collapse, but with a slow repricing of trust. And ordinary people feel that repricing long before they understand the chart. They feel it in mortgage rates. They feel it in credit card APRs. They feel it in car loans. They feel it in business financing. They feel it in insurance. They feel it in rent. They feel it in the cost of staying alive. This is why Jamie Dimon's warning is not just a Wall Street story. It is a household story. Because when the government's debt gets more expensive, the entire economy gets more expensive. Now let's talk about the hidden bomb. Private credit. Private credit sounds complicated, but the basic idea is simple. Some companies cannot get the loan they want from a traditional bank. Maybe they are too risky. Maybe their cash flow is weak. Maybe the bank does not want the exposure, so they borrow from private lenders instead. Private funds, asset managers, business development companies, alternative credit platforms. This market has grown enormously over the last decade. It expanded during the era of cheap money. When interest rates were low, investors were desperate for yield. Private credit offered higher returns. Companies got funding, funds, collected fees. Investors felt sophisticated. Everything looked fine, until the cost of money changed. When rates rise, debt that looked manageable can become dangerous. Companies that could survive at low rates may struggle at higher rates. Loans that looked safe may need to be marked down. Borrowers may miss payments. Funds may face redemption pressure. And suddenly, the private credit market starts showing cracks. This is why recent headlines around BlackRock, Blackstone, Blue Owl, Apollo, and other private credit vehicles matter. The issue is not that every private credit fund is collapsing. That would be too simple. The issue is that stress is becoming visible in a market that was sold as stable, income producing, and less volatile than public markets. Reuters reported that Blackstone and BlackRock cut valuations in private credit funds after pressure from troubled software sector loans. BlackRock's HPS Corporate Lending Fund also limited withdrawals after redemption requests exceeded its quarterly cap. These are not normal signals for ordinary investors to ignore. They are signs of liquidity stress. And liquidity stress is where financial confidence begins to change. Because the most dangerous moment in finance is not when people lose money. It is when people realize they cannot get their money back when they want it. That is when psychology changes. That is when investors stop asking about yield and start asking about exits. And in private credit, exits can be complicated. These loans are not always traded like public stocks or treasury bonds. They can be illiquid, hard to price, hard to sell quickly. And when many investors want liquidity at the same time, funds may have to limit withdrawals, sell assets, mark down values, or restructure loans. That is the private credit trap. High yield going in, low liquidity coming out. Now connect this back to Jamie Dimon. If private credit stress grows, it does not stay inside private credit. It can spread. Pension funds may take losses. Insurance companies may reduce risk. Asset managers may sell more liquid assets to meet cash needs. Businesses may lose access to financing. Layoffs may rise. Small companies may fail. Banks may tighten lending. Credit conditions may get worse. And when credit tightens, the real economy slows. That is how a hidden credit problem becomes a street-level problem. It starts in a fund document, then it becomes a hiring freeze, then it becomes layoffs, then it becomes lower consumer spending, then it becomes empty restaurants, then it becomes small business closures, then it becomes more credit card debt, then it becomes households choosing between saving and surviving. This is the chain most market videos do not show. Minority Mindset is right to explain the investment angle, but Broken Economy is looking at the transmission mechanism. How does Wall Street stress become Main Street pressure? That is the real story. Now look at the software sector. This is where private credit and technology collide. Over the last decade, many software companies were valued like growth could last forever. Recurring revenue, high margins, enterprise contracts, subscription models, cheap financing. It looked like the perfect business. But AI is changing the equation. Some software companies are now facing pressure from automation, lower switching costs, cheaper AI tools, and customers questioning what they really need to pay for. If revenue slows, while debt costs rise, the balance sheet becomes fragile. And if those companies borrowed through private credit Their lenders now have to face reality. The loan may not be worth what the model said it was worth. That is why AI is not just a stock market story, it is a credit story. AI can boost some companies, but it can also destroy the assumptions behind others. And when assumptions break inside leveraged companies, the losses do not stay theoretical. They show up in fund valuations. They show up in markdowns. They show up in non-accrual loans. They show up in investor redemptions. They show up in frozen liquidity. This is the new technology credit crisis. Not every AI winner creates wealth for the economy as a whole. Some AI winners destroy the cash flows of old software businesses. And if those businesses were financed with private credit, the damage moves through the lending system. That is why Jamie Dimon's warning and the AI economy are connected. The same technology that makes investors excited can also expose debt that was built on outdated assumptions. Now let's bring this to the street. Imagine a household in Southern California. On paper, they are doing fine. Maybe they make $100,000 a year. Maybe they have a retirement account. Maybe they own some index funds. Maybe they have a job in tech, logistics, healthcare, finance, or services. But their cost structure is brutal. Rent is high. Insurance is high. Gas is high. Groceries are high. Electricity is high. Credit card rates are high. Car payments are high. Healthcare is high. And savings are thin. Now imagine the credit system tightens. Companies stop hiring. Software firms cut jobs. Small businesses lose financing. Credit cards get more expensive. Banks reduce risk. Investment funds mark down assets. Retirement accounts become more volatile. That household does not experience this as private credit stress. They experience it as anxiety, less job security, less cash flow, more debt pressure, more uncertainty, and a feeling that no matter how hard they work, the system keeps moving the finish line. That is the broken economy. The financial system takes risk in complex places, but the ordinary household absorbs the consequences in simple places. Bills, jobs, debt, prices, savings. That is why the private credit story matters. Because it is not just a rich investor problem, it is part of the same credit machine that supports the economy. When credit expands, everyone feels rich. When credit tightens, everyone discovers who was dependent on borrowed time. Now let's talk about the Treasury connection. This is the part that makes the story dangerous. When investors lose money in risky assets, they often sell what they can sell, not always what they want to sell. If private credit funds, pensions, insurance companies, or leveraged investors need liquidity, they may sell liquid assets. Treasury bonds, stocks, ETFs, high-quality securities. That can create pressure in supposedly safe markets. And if Treasury yields rise because supply is already massive and buyers demand more compensation, the government's debt problem gets worse. This is how private credit stress can feed into the bond market. Not because private credit is bigger than treasuries, it is not, but because liquidity stress can force selling behavior across markets. And when the treasury market gets stressed, the entire financial system feels it. Mortgage rates feel it. Corporate borrowing feels it. Bank balance sheets feel it. Government deficits feel it. Households feel it. This is why Jamie Dimon's bond crisis warning matters. A bond crisis is not just a chart moving, it is the price of money changing for everyone. And when the price of money changes, the weakest balance sheets break first. Highly indebted companies, overextended consumers, weak commercial real estate, fragile private credit borrowers, small businesses with floating rate debt, households living paycheck to paycheck. That is where the damage begins. Now think about the usual advice. Buy the dip, stay invested, hold for the long term, own assets, avoid cash. That advice can be useful, but it does not answer the liquidity question. What happens if the market falls when you need cash? What happens if your job disappears during a credit contraction? What happens if your retirement balance is up but your emergency fund is gone? What happens if your private investment says it is worth something, but you cannot withdraw when you need the money? What happens if the asset is priced, but not liquid? That is the difference between wealth and access. A portfolio can look strong on paper, but if you cannot turn it into usable money at the right time, it may not protect you. This is why liquidity matters, cash flow matters, emergency savings matter, debt levels matter, job stability matters, and risk management matters. Not because fear is a strategy, but because denial is not a strategy either. Jamie Dimon is warning that the system has real stress. Minority mindset is explaining how investors might position around it. Broken economy is showing why ordinary people need to understand the pressure before it reaches their paycheck. This is not about predicting the exact day of a crash. It is about recognizing the structure. The United States has too much debt. The government is borrowing aggressively. Interest costs are rising. Private credit has grown rapidly. Some borrowers are under stress. AI is disrupting business models. Liquidity is becoming more important. And households are already financially stretched. That is not one isolated problem. That is a cluster of pressure. And when pressure clusters together, small shocks can become big events. A default here, a fund gate there, a software company bankruptcy, a bank tightening lending, a pension fund reducing risk, a treasury auction demanding higher yield, a consumer pulling back, a small business closing. Individually, each event can be explained away. Together, they form a pattern. That pattern is what Jamie Dimon is warning about. The cracks are not always loud at first. Sometimes they show up as markdowns, withdrawal limits, non-accrual loans, quiet layoffs, lower hours, empty storefronts, more credit card usage, less saving, more people saying the same thing: I am working, but I cannot get ahead. That is the real crisis. Not just debt on a government spreadsheet, not just private credit on a fund balance sheet, but a society where every layer of the economy depends on borrowing more just to maintain the illusion of stability. So, what should people watch? Watch Treasury yields, watch credit spreads, watch private credit fund redemptions, watch business development companies, watch software bankruptcies, watch layoffs in tech and services, watch credit card delinquencies, watch auto loan stress, watch small business closures, watch whether ordinary people can still save money after paying for basic life. Because the first signs of a debt crisis often appear before the official crisis. They appear in behavior. People stop spending, companies stop hiring, banks stop lending, funds stop redeeming, households stop saving, and once enough people stop at the same time, the machine starts to reveal what it was really running on: debt, confidence, and the belief that tomorrow would always be easier than today. That belief is now being tested. Go to the comments and tell us what you are seeing in your city. Are people using more credit cards just to get through the month? Are restaurants getting quieter? Are tech workers getting nervous? Are small businesses cutting hours? Are people still saving or just surviving? Minority mindset, explained Jamie Dimon's warning. Broken economy is showing where that warning goes next. Because the private credit crisis is not just hidden inside Wall Street. It is already moving through the real economy. And when the debt machine starts to slow down, ordinary people are always the last to be warned. Subscribe to Broken Economy for more clear breakdowns of finance, technology, and the real economy behind everyday life. Stay awake. The crisis does not begin when everyone sees it. It begins when the exits get smaller.